Assalamualaikum and good greetings. We are part 5 accountancy students from UiTM Alur Gajah Melaka will be presenting our group project for subject corporate finance MAF603.
Hi, I am Nurul Amalina. Me and Muhammad Amirul Syafiq will be presenting for the case 1. So first, let's go through the question. New waves of the COVID-19 outbreak in major parts of the world may have sparked fears of double-digit recession, but Trademark Auto Berhad, the official distributor of Mazda cars and spare parts in Malaysia, remains optimistic that the global economic growth is on track. Due to that, Trademark Auto Berhad is considering 3 possible financing arrangements to raise 100 million ringgit of new capital for its business. So there are 3 alternatives, which is Alternative 1, finance with only new equity, Alternative 2, finance using 50% debt and 50% equity, Alternative 3, finance using only new debt. So the proceeds may be utilized to finance working capital requirements, investment, acquisition, and capital expenditure, and general corporate purposes. Currently, the capital structure consists of no debt and 250 million ringgit in equity. There are 100 million shares of common stock currently outstanding, selling at RM2.50 per share. The expected earnings of 200 million ringgit before interest and taxes are expected for next period. The interest rate on any debt obtained should be 10%. So we have 100 million ringgit for the new capital for its business. Then we have 250 million ringgit all in equity. Next, for the 200 million ringgit is the EBIT and 10% for the RB. For required A, we need to calculate the earnings per share for each alternative. So the EPF formula is EBIT after interest divided by the number of shares outstanding. So let's go through the working how we get the shares outstanding. Share outstanding were equity divided by the share price. In the value, we get 350 million by stated in the question, 250 million ringgit equity plus with the new capital structure 100 million ringgit. So the total is 350 million. In the alternative A, since there is no debt, the value 350 million 100% go to the equity. So 350 million ringgit divided by the share price RM2.50, we get shares outstanding of 140 million shares in the alternative 1. For alternative 2, since it financed 50% debt and 50% equity, so the 100 million ringgit of the new capital need to proportionate 50% for the debt and 50% in the equity. So 50 million ringgit go to the debt and 250 million in the question of equity plus with the new capital of 50 million for equity. So 250 million plus 50 million new, the total is 300 ringgit. 300 million ringgit. So 300 million ringgit divided by the RM2.50, we get 120 million shares outstanding for alternative 2. Lastly, for the alternative 3, since it finances using only new debt, so 100 million ringgit of the new capital structure all will go to the debt, and the remaining 250 million they already stated in the question will still in the equity. So the 250 million ringgit equity divided by the 2.5 ringgit, we get 100 shares outstanding for alternative 3. Okay, so let's calculate the EPS. For alternative 1, we have EBIT 200 million, and since there is no debt, so there is no interest. 200 million divided by 140 million of share outstanding, we get the total RM1.43. For alternative 2, since we have 50 million debt, so 50 million times with 10% of RB given in the question, so EBIT 200 million ringgit minus with 5 million of interest divided by the share outstanding 120 million, and the total we get 1.63 ringgit. And then for alternative 3, we have a debt 100 ringgit million, so plus times with the 10% RP, we get interest 10 million ringgit. So EBIT 200 million minus with the 10 million ringgit interest divided by the 100 million of shares outstanding, and the total we get is 1 ringgit 90 cents. Next, for required B, we need to determine the distribution of income between debt holders, shareholders, and the government of each alternative. In the alternative 1, we have EBIT 200 million ringgit, and since there is no debt, there is no interest, so the EBT, earnings before taxation, will be 200 million ringgit, and nil for the taxation since the question doesn't given the taxation percent. So 200 million ringgit of interest after taxation will be distributed 100% to the shareholders since we have no bond holders, and 0 ringgit income for the government since we have no taxation. Next, for the alternative 2, since we have 50 million ringgit of debt, so we get 5 million ringgit of interest. The 200 million EBIT minus with the 5 million interest, we get 195 million ringgit of earning before taxation. Nil for taxation, so 195 million ringgit of earning after taxation will be distributed 50% to the shareholders and 50% to the bondholders. The government also receive 0 ringgit from the alternative 2 since there is no taxation. Lastly, for the alternative 3, we have 100 million ringgit of debt, so we get 10 million ringgit of interest for alternative 3, and the EBIT of 200 million ringgit minus with the interest 10 million ringgit, we get 190 million ringgit for the earning before taxation and nil for the taxation. The earnings after taxation of 190 million ringgit will be distributed to shareholders and bondholders. So how we get this amount is by 100 million debt divided by the 200 million of equity and times with the 100 million of the EAT, so we get 76 million ringgit for the bondholders. So the remaining 190 million minus with the 70 million to the bondholders will be remaining 114 million ringgit and distribute to the shareholders.
Question C. In the view of the benefit and expense of debt funding, the corporation agreed to issue an additional debt of RM60 million, resulting a debt-to-equity ratio of 1.5, primarily for the purpose of increasing its capital requirement. By applying Modigliani-Miller proposition, calculate the value and the overall cost of capital of trademark Autoberhype. In this question, they give us the debt RM 60 million, additional debt RM 60 million ringgit, and debt to equity ratio 1.5. Debt to equity ratio formula is debt over equity, which is we found debt 1.5 and share is 1. The value of the firm is 1.5 debt plus 1 share equal to 2.5. To calculate the amount of debt, we use 1.5 divided by 2.5 times 350 million equal to 110 million. And share 1 over 2.5 times RM 350 million ringgit equal to RM 140 million. To calculate the value of the firm, we use the formula debt plus share. And the value of debt is RM 210 million plus RM 140 million equal to RM 350 million. And second, we need to calculate the overall cost of capital of Trademark Auto Berhad. Firstly, we need to calculate the RO for the firm. We use the formula RO equal to EBIT over value of the firm. And the EBIT was given in the question, which is RM 200 million, and the value of the firm is RM 350 million. We get 0.57%. In the Modigliani-Miller proposition, they said the RO is equal to RWACC, which is equal to 0.57%. On question B, we need to explain why debt levels vary across sectors and within industry. We found 3 reasons. First, on the tax, second, type of asset, and third, operating income. On the tax, firms who have debt can get tax savings by reducing the profit of the firm from interest of the debt. The highly profitable sector and industry are more likely to have larger target in the debt to equity ratio than less profitable sectors and industries. The highly profitable sector and industry can get more deduction on tax when they can reduce their earnings after interest by deduct the interest from the debt. Second, type of asset. We have 2 types of assets. First, tangible assets, and second, intangible assets. The sector and industry have large investment in land, buildings, and other tangible assets. It will have smaller costs of financial distress than the sector and industry with larger investment in research and development, which is intangible asset. The sector and industry with larger tangible assets can overcome the financial distress problem easily by liquidating some of their assets. Therefore, the firm with larger investment tangible assets can have a higher debt to equity ratio than the firm with larger investment in tangible assets. Lastly, in operating income, the sector and industry who have uncertain operating income should finance their firm with most of equity to avoid financial distress. They cannot predict their income in the future to make decisions about how much debt they can issue. If they make wrong decision, it will lead their firm to financial distress. The firm that can predict their operating income can have a higher debt to equity ratio because they know how much debt they can take.
Hi, my name is Shaihizatul. Me and Khairina Sofia will presenting case 2. So let's start with the question first. Randy Property Berhad is planning to invest in a project which will involve diversification into a new industry. Due to rising health cases nowadays, Randy Property plans to increase business focus in the industry related to healthcare, that is on the diagnosis and remote monitoring of heart rhythm disorders. It will become part of Randy's connected care business, which offers a range of platforms and devices that allow patients to stay at home while being monitored. The management of Randy Property Berhad expected to deliver double-digit growth and improve its earnings before interest and tax to more than 20% by 2025. The finance manager of the company has analyzed two companies that are identical in every respect except for their capital structure. Their market values are in equilibrium as follows. The total value of geared is higher than the total value of ungeared, which is consistent with MF. All profit after tax are paid out as dividends, and so there is no dividend growth. The beta value of ungeared has been calculated as 1. The debt capital of geared can be regarded as risk-free. For question K1, calculate the following cost of equity to the equity holders in the geared company. In order to get the cost of equity in the geared company, we will use the KE formula, which is D1 divided by P plus G. So D1 represents as profit after tax that are paid out as dividends amounting 510,000 ringgit, that will divide it with the market value of equity amounting 3.9 million ringgit. Since the question already stated that there is no dividend growth, we consider the growth rate is 0. Therefore, the total amount cost of equity is 13.08%.
Next, to find the beta value of geared, we should find first the beta asset for ungeared, which is using the formula given. Beta equity times with value of equity, then divide by value of equity plus value of debt and times with 1 minus tax. 1 is the beta equity times with 6,600,000, then divided with 6,600,000 plus 0 debt times with tax, which is 1 minus 0.25, then it proves that beta is 1. Now, to find the beta value of geared by using the formula given. Beta asset times with value of equity plus the value of debt times with 1 minus tax, then divide by value of equity. Now, we take 1 as a beta asset times with 3,900,000 plus 4,180,000 times with tax 1 minus 0.25, then divide with 3,900,000. So, the value of beta geared will get 1.8. Okay, now we move to B. Explain the leverage effect and the implication to companies if earnings are insufficient to cover interest obligations. When the earnings are insufficient to cover interest obligations, it shows that the firm faces a poor interest coverage ratio. This situation happens when the firm is over-leveraged financially. It is where the firm incurs a large debt by issuing the fund at a lower interest rate and using the surplus fund for high-risk investment. So, the effect and implication is that the investment risk outweighs the rate of return, where the value of equity of the firm will reduce as shareholders think it would be too risky.
For question C, discuss the relationship between financial distress and capital structure and propose the considerations to be addressed by using debt financing. First of all, what is capital structure? Capital structure is the combination of debt and equity to finance its overall operation and growth of the company. The relationship between the financial distress and capital structure is when the capital structure of the firm issues more debt than equity, and the commitment to pay the debt and tax are not fulfilled by the firm. So, the financial distress may happen. Thus, it will lead the firm at bankruptcy risk. The firm should consider using debt finance because the value of the firm depends on the firm's debt and equity. So, when debts firm increase, the earning per share will increase. Thus, tax saving also exists. Therefore, this will increase the value of the firm, where the shareholder may maximize its wealth return.